The following is presented for educational commentary and should not be taken as a personal statement from any named individual. Always do your own research. 130 hook, see hook block above. 133.30, the big stamp. Let me say that number one more time so it really lands. $189 billion. That is how much cash Warren Buffett's company, Berkshire Hathaway, is holding right now. Not invested, not in stocks, not in bonds, sitting in short-term treasury bills. Cash. Show on screen, Berkshire Hathaway Q1 2025 balance sheet, cash line. Now, I have been watching Berkshire for a long time. I want you to understand how unusual $189 billion is. In 2019, Berkshire held about $128 billion in cash. People called that a lot. In 2021, when everyone was buying everything, Berkshire held about $144 billion. People said he was missing the rally. Now it is $189 billion. That is $61 billion more than just a few years ago. If you lined up $61 billion in $1 bills, the stack would reach the moon. And I do not say that to be fancy. I say it so a 13-year-old can understand how much money this is. Here is why this matters to you as a retiree or a person close to retirement. Warren Buffett has said publicly many times that he only holds a lot of cash when he cannot find stocks that are cheap enough to buy. He is not waiting because he is scared. He is waiting because he is patient. He wants prices to come down before he puts his money to work. And when a man who has beaten the market for 60 years thinks prices are too high to buy, I think that is worth paying attention to. I have been wrong before, I will be wrong again, but I want you to have this information. $189 billion, write that number down. 337.00, the story so far. Let me take you back, let me show you how we got here, because context is everything. In the late 1990s, the internet was new. Companies were going public with no profits, no products, sometimes no real business plan at all. People were throwing money at anything with a .com in the name. Show on screen, Nasdaq chart 1995 to 2002. Warren Buffett did not buy those stocks, he sat on cash, people laughed at him. Magazine covers said he had lost his touch. A famous article in 1999 said, and I am paraphrasing here, that Warren Buffett may have simply passed his prime. Voice drop, then the Nasdaq crashed. It fell more than 75% from its peak. Companies worth billions became worth zero. Retirement accounts that people had spent 20 years building got cut in half. Some people never recovered. And Buffett, he was ready. He used his cash pile to buy great companies at low prices. He bought more of American Express. He added to his position in Wells Fargo before it had its big run. He came out of the .com crash far stronger than he went in. That was in the year 2000, 25 years ago. Now let me take you to 2008, the housing market. That is a different decade and a different lesson. In 2007, the housing market was flying. Banks were giving out mortgages to people who could not pay them back. People were flipping houses the way people flip cars. Everyone felt rich. Buffett did something interesting in 2008. He did not just sit on cash this time, he deployed it carefully. He made a deal with Goldman Sachs in September 2008, right in the middle of the panic, and bought preferred shares that paid him 10% per year plus gave him warrants to buy Goldman stock at a fixed price. He bought $3 billion worth. Show on screen, Berkshire 2008 press release, Goldman deal. Goldman stock had fallen hard. Buffett had cash ready. He could pick his spot. He made a tremendous amount of money on that deal over the next several years. The lesson I take from 2008 is not just that you need cash. The lesson is that you need to know what you want to buy before the crash happens, because in a panic, you do not have time to think. You need a shopping list already written. I will come back to this in a few minutes when I talk about the 3 things you need to do before July 1st. Now let me bring you to today, to 2025. The market has had a long run. The S&P 500 index has gone up a lot since the 2020 COVID crash. We went from about 2,200 on the S&P 500 in March 2020 to over 5,000 recently. That is more than a double in 5 years. Show on screen, S&P 500 chart, 2020 to 2025. At the same time, interest rates have gone up fast. The Federal Reserve raised rates from near 0 to over 5% in a short period of time. That changes how everything is valued. And in the middle of all of this, Buffett has kept raising his cash pile, higher and higher month after month. $189 billion. He is not buying, he is waiting. 70011-002 instruments. I want to give you 2 simple tools today, 2 ideas you can use right now. You do not need a finance degree for either one. The first tool is what I call the patience test. Here is how it works. Before you buy any stock, ask yourself one question: would I still want to own TH? Is if the price fell 30% next year. That is the whole test, one question. If the answer is yes, you might be buying a real business at a price you believe in. If the answer is no, you might be buying a ticker symbol because it went up lately. Warren Buffett talks about this idea constantly. He calls it buying a business, not a stock. He says, and this is educational commentary, not his direct words, that he imagines buying the whole company, not just a few shares. Would you buy the whole company at today's price? If yes, you are thinking like an owner. If no, you are speculating. Here is a real-life example. Think about Coca-Cola. Berkshire bought its first shares in Coca-Cola in 1988. The price was around $2.45 per split-adjusted share. Buffett paid about $1.3 billion for his initial position. Show on screen, Berkshire Hathaway 1988 Annual Report, Coca-Cola reference. Today, Berkshire's Coca-Cola stake is worth more than $25 billion. And every year Berkshire collects over $750 million in dividends alone from that one position. Buffett has said he will never sell Coca-Cola, not because of the price, because of the business. He passed the patience test before he ever bought the first share. Now ask yourself this: the last stock you bought, could you pass the patience test on it? Some of you will say, Mark, I do not have time to analyze businesses. I just want to be safe. I hear you, and that leads me to the second tool. The second tool is what I call the 2-bucket rule. Here is the idea: split your investable money into 2 buckets. Bucket 1 is your safe bucket. This is money you will need in the next 3 to 5 years. Living expenses, medical bills, car repairs, trips you planned. This money does not go in the stock market. This money goes in something like a high-yield savings account, a treasury bill, a CD, a money market fund. Right now you can get about 4.5% to 5% on short-term treasuries without taking any stock market risk. Show on screen, current treasury rates, 3-month and 6-month T-bill rates. Bucket 2 is your growth bucket. This is money you will not need for at least 5 years, maybe longer. This is the money that can sit in stocks and ride out any storm that comes. The 2-bucket rule is simple, but I cannot tell you how many people I have seen make the mistake of not separating these 2 things. They put all their money in stocks, then the market drops 30%. They panic because they need money for next year's expenses. They sell at the worst time. Think about someone who retired in the year 2000 with all their money in the stock market. The Nasdaq fell 75%. The S&P 500 fell about 48% from peak to trough. If that person needed income every month and had no safe bucket, they were forced to sell stocks at the bottom to pay their bills. They locked in those losses forever. Voice drop, that is the retirement version of the worst thing that can happen. Not losing money on paper, losing it permanently because you needed it before prices came back. The two-bucket rule protects you from that. It gives you patience. And right now, when Buffett is sitting on $189 billion and not buying, having a safe bucket feels very wise to me. 11-00-15-00 Case Studies. Let me give you two real examples, real people, real situations, real numbers. The first example is a man I will call Raymond. That is not his real name, but his situation is real. Raymond retired at 64 in early 1999. He had $800,000 saved. He was proud of it. It had taken him 35 years of working, saving, and staying focused. He put most of it into technology mutual funds because his broker told him technology was the future, and for a while the broker was right. By March 2000, Raymond's $800,000 had grown to about $1.1 million. He felt great. He started spending a little more. He bought a boat. He helped his daughter with a down payment on a house. Then the crash came. By 2002, Raymond's $1.1 million had fallen to about $380,000. More than 65% gone. He had to go back to work at 67. He worked until he was 73. He never went back to where he was. Raymond did not make one big wrong decision. He made two small ones. He did not separate his safe bucket from his growth bucket, and he did not ask himself the patience test before he bought. Voice drop, I am not telling you Raymond's story to scare you. I am telling it to you because you still have time to make a different choice. The second example is a woman I will call Frances. Real situation, changed name. Frances retired in 2007 at 61. She had $650,000 saved. Her financial advisor suggested splitting her money. About $150,000 went into a ladder of CDs and short-term bonds, enough to cover 5 years of expenses. The rest, about $500,000, went into a balanced portfolio of stocks and bonds. In 2008, the stock portion of her account fell hard. The S&P 500 lost about 38% in 2008 alone. Frances felt it. Her growth bucket shrank from $500,000 to about $310,000 on paper. But here is the key word. On paper. Because Frances had her safe bucket, she did not sell a single stock. She did not have to. She lived off her CD ladder while the market was low. And when the market came back, and it did come back, the S&P 500 was back to new highs by 2013. Frances rode the whole recovery. By 2015, Frances' total account was worth more than she started with in 2007. Same crash, two different people, two completely different outcomes, all because of how they were set up before the crash. 15-00-22-00 The lesson. Let me pull this together. What is the lesson from 2000? What is the lesson from 2008? And what does Buffett's $189 billion cash pile tell us about today? I want to be clear, I do not know when the next market drop will come. Nobody does. Anyone who tells you they know the exact timing is not telling you the truth. But I do know this. When the most patient and successful investor in history is sitting on the most cash he has ever held, and when the stock market has more than doubled in the last 5 years, and when interest rates are the highest they have been in 15 years, it is a good time to check your setup. Not your returns, your setup. Are you using the two-bucket rule? Do you have enough in a safe bucket to cover your living expenses for the next 3 to 5 years without touching the stock market? Are you passing the patience test? Do you own businesses you believe in for the long term, or do you own tickers you bought because they went up? And are you holding some cash, the way Buffett is holding cash, so that if prices do fall, you have something to put to work? I want to tell you something I think about often. I call it the waiting room moment. In 2009, right after the worst of the financial crisis, there were great companies selling at prices we had not seen in 10 or 15 years. Johnson & Johnson, Procter & Gamble, Apple, these were not bad companies, they were great companies on sale. But most people were not buying in 2009. Most people were scared. Some people were pulling their money out of the market entirely. They went to cash not as a strategy but as a reaction to fear. And they missed one of the greatest recoveries in stock market history. Voice drop, the people who had cash ready, cash they had held on purpose, were the ones who could walk into that waiting room and buy when it hurt to buy. That is what Buffett does. That is what he has done for 60 years. He does not react to fear, he prepares for opportunity. Right now he is preparing, and I think you should be too. Let me add one more layer to this. Some of you will say, Mark, Buffett has been holding a lot of cash for years and the market has just kept going up. He has missed gains by sitting out. Is he wrong? That is a fair point, and I want to address it directly. Here is my answer. Buffett is not trying to catch every last dollar of a bull market. He is trying to make sure he can survive and thrive in the next bear market. He thinks in decades, not quarters. Could the market go up another 20% before it falls? Yes. Could it fall 30% next month? Yes. Nobody knows. What Buffett knows is that at $189 billion in cash, he will be ready for either outcome. If stocks keep going up, he can still buy good businesses that come available. If stocks fall hard, he can buy at great prices. That is what I want for you too, not a prediction, a position. Now let me talk about the specific stocks that the market is missing right now. And I want to be careful here because I am not telling you to buy anything. I am not a financial advisor and this is not financial advice. I am showing you what the value-oriented thinking looks like so you can have an educated conversation with your own advisor. Show on screen, list of sectors Berkshire has historically favored. Berkshire today holds large positions in energy. They own a big stake in Occidental Petroleum. They own a utility company called Berkshire Hathaway Energy. They own Burlington Northern Santa Fe, one of the largest freight railroads in North America. They own Geico, one of the largest auto insurance companies in the country. Do you notice something about those businesses? Not one of them is a hot technology startup. Not one of them is chasing the latest trend. Every one of them moves real things, insures real things, or powers real things. Buffett has said in his public letters and public interviews that he favors businesses with what he calls a moat. A moat is a protection, like the water around a castle. A company with a moat has something that makes it hard for competitors to take its business away. Coca-Cola has a moat. It is one of the most recognized brands on earth. You could not start a cola company tomorrow and beat it. That is the moat. Burlington Northern has a moat. It owns rail lines that took 100 years to build. You cannot build another rail line next to it. That is the moat. Geico has a moat. It sells directly to customers, which makes it cheaper than competitors who use agents. Lower cost is a moat. When you are looking at stocks before July 1st, I want you to think about moats. Does this company have something that protects it, or is it just riding a wave? Show on screen, simple checklist graphic, patience test plus moat test. Now let me also talk about what Berkshire is not doing right now, because I think this is just as important. Berkshire is not buying speculative tech companies. It has actually been selling some of its Apple stock, which was its largest holding. It sold a lot of it in 2024. At one point, Apple made up more than 40% of Berkshire's stock portfolio. Now it is closer to 25% or 26%. Show on screen, Berkshire 13F filings showing Apple position reduction. That does not mean Apple is a bad company, it clearly is not. But when one stock becomes too big a percentage of your portfolio, even a great stock, it adds risk. Buffett reduced that risk, he took some profits, he added it to the cash pile. Is that a lesson for you? Maybe. If you have one stock that is now 30%, 40%, 50% of your retirement savings, that is worth a conversation with a professional. Not because anything is wrong with the stock, but because concentration is risk, even in a great company. 2200 2700 3 things to do before July 1 ST. This is the part no one ever tells you. 3 concrete steps, plain and simple. First, check your safe bucket. If you are retired or within 5 years of retirement, you need a safe bucket. This is cash or near cash that covers your living expenses for at least 3 years, ideally 5. Count what you spend each month on housing, food, utilities, insurance, medical, and travel. Multiply by 36 for 3 years or 60 for 5 years. That number is your safe bucket target. If you do not have that amount sitting in something safe, a high-yield savings account, a money market fund, a treasury bill ladder, a CD, that is step 1. Build it before you do anything else with your investments. Right now, short-term treasury bills are paying close to 5%. A 6-month T-bill at 5% is not exciting, but it is not scary either. And right now, not scary is valuable. Show on screen, Treasury Direct website, how to buy T-bills directly from the government. Second, run the patience test on every stock you own. Go through your portfolio, stock by stock, holding by holding, and for each one ask yourself that one question: would I still want to own this if the price fell 30% next year? If the answer is yes for a stock, write it down, that is a keeper. If the answer is no, that is a conversation you might want to have, maybe with yourself, maybe with a financial advisor, not a reason to panic sell, but a reason to think. This is not about timing the market, it is about knowing what you own and why. If you cannot say in one sentence why you own a stock, that is a warning sign. Buffett can say in one sentence why he owns every single position in Berkshire's portfolio. Can you say the same about yours? Third, make a shopping list. This is the step most people skip, and it is the one that separates the people who do well in a market drop from the people who freeze. Before prices fall, decide what you would buy if prices fell. Pick 2, 3, maybe 4 companies or funds you respect, companies with moats, companies that have been around for 50 or 100 years, companies that sell things people need no matter what the economy does. Write them down, write the price at which you would feel comfortable buying them, not because you think the price will definitely fall to that level, but because having a number in your head keeps you rational when your emotions are screaming at you to sell everything and hide. Buffett does not make his best investments during calm markets. He makes them during panics. He can do that because he has already done the homework before the panic. He already knows what he wants to buy, he just waits for the price. You can do the same thing, not at Buffett's scale, but with the same mindset. Show on screen, simple paper notebook or spreadsheet with 3 columns, company, why I like it, price I would buy at. Let me give you a quick real-world example of what a shopping list might look like. I am not recommending any of these. I am using them as examples of the kind of thinking I mean. Imagine someone who likes consumer staples companies, companies that sell food, household products, toothpaste, soap. These companies tend to hold up better in recessions because people still need to eat and clean their teeth even when money is tight. That person might write down something like Procter & Gamble. I like it because it has been around for almost 200 years. It has raised its dividend for 67 years in a row, and it sells products in almost every country on Earth. I would feel comfortable buying it if the price fell to around X. That is a shopping list item. Simple, specific, not based on what it did last week, based on what it does every year. You are not predicting the future. You are preparing for a range of futures. That is all investing ever is. Let me take a step back and give you the big picture one more time before I close. $189 billion, that is Buffett's cash, the most cash Berkshire has ever held. In 2000, he held a lot of cash and was called out of touch. The dot-com crash followed. In 2008, he put cash to work at exactly the right time and made extraordinary returns. Today he is holding cash again, not because he is scared, because he is patient and he does not see enough that is cheap enough to buy. The two tools I gave you, the patience test and the two-bucket rule, are your way of building that same kind of patience into your own life. The 3 steps: build your safe bucket, run the patience test on what you own, make a shopping list, are concrete things you can start doing this week, before July 1st. Not because July 1st is a magic date, but because having a deadline turns a good idea into an action. I want to say one more thing before I get to the close. I have talked in this video about stocks and cash and Warren Buffett, but the most important thing I want to leave you with is not a number or a strategy. It is a feeling. The feeling of being prepared. When you have a safe bucket, when you know what you own and why, when you have a shopping list ready for when prices fall, you do not feel panic during a market drop. You feel possibility. You feel like Francis in 2008, not Raymond. You see a sale, not a disaster. That feeling is worth more than any stock tip I could ever give you.